Hello and welcome. This is Gordon De Silva from the award-winning firm Gordon's Knight, and I'm here to bring you my take on the budget 2016, March 2016 with George Osbourne. I'm going to go through the bits that are relevant to clients more than just everything. So I'm going to skip over bits in our report. You will be able to download the report on our site, but if you prefer to listen to it or read it and watch it, then you can watch this video. Into a pension or a small enterprise investment scheme, and the cost of that would be dramatically reduced because the opportunity cost would be paying 60% tax. So that's the thinking that we bring. That's why we spend so much time with clients and working with clients on their affairs, because the time we spend can have a dramatic effect on their income and their take-home income, their wealth, and their family's wealth. Let's look at income tax bands very quickly. The 20% band will be £32,000. Remember, this is in addition to the 11,000 tax-free band, or next year 11,500. And in the following year, it's going to be 33,500. That means that you will pay 40% if your taxable income exceeds 43,000. That's the 32 plus the 11 is the 43,000. If your income exceeds that, you'll be paying 40% tax, unless you're on dividends, in which case the pain comes in at 47.5% tax, and even the 20% becomes 27%, 27.5% tax. That's a 30% increase in tax, but more of that later. Remember, the 40% top rate continues to apply to taxable income over £150,000. They're not proposing to put that up. There are some changes to ISAs, and I'm not going to go through that. And pension allowances are reduced, and I'm not going to go through that because it is, if you're right for a pension, then you'll ask me for a referral, and I'll introduce you to a couple of financial advisors who are really good at what they do and professional and qualified to take your money and follow your instructions on, either cautious or moderate or risky investments, so that you can do something more than the banks are offering you, maybe 0.5% or 1% or something. So let me leave you with that. And I'm going to talk a little bit about the £1,000 saving income, because if your interest is £1,000, and I just say the interest is 1% from a bank, you'd have to have £100,000 in cash in deposit. Not many of us have that sort of money, but if you do, then we are going to be getting £1,000 of interest tax-free, unless we are higher rate taxpayers. And if we're higher rate taxpayers, that limit is brought down to £500. So those of us who have a significant amount of income and interest, then our tax-free element is only going to be £500. And it's better than nothing, but keep that in mind. Remember that if your income is over 150,000, which I hope it is, then you get taxed on all your interest income. Well, that's fair enough. You've got enough. We can make more income than what we lose in this. £500. It's not worth concentrating on £500 if you're making 150, 250,000 pounds, because it's easier to make an extra £5,000 than it is to try to save £500 in tax, isn't it? So what will have to happen for this to happen is the banks are going to be paying you interest gross from April 16, which means that there's a whole range of things that may need to happen. You may need to look at your tax returns and what you declare in your tax returns. If we do that for you, please make sure you put all your interest earning accounts in with us, because omitting this can have a dramatic effect on your tax bill. Okay, that's it for that section. I'm now going to go on to the things to do with companies, so we'll reconvene on that video in a couple of minutes time. On the next video you can log in, it'll be introduced again, but you can skip the first few minutes of the introduction if you wish. Hi, and thank you for this second part. We're now going to be talking about dividend rules, company tax, that sort of thing, in this bit as a result of the budget March 16. So dividend rules are changing, and the 6th of April, the biggest change for many years, we're going to be seeing a massive hit to owner director companies. These are directors who own a limited company, who have shares in that company, and who decide to pay a low salary, high dividend methodology for getting their remuneration. And it has been the flavor of my month for over 30 years. And I remember when I first started doing this, my bosses at the time, my partners at the time, said, "You must be mad. It's going to, you're going to jeopardize the client's business." I was proved right, fortunately, and clients of mine for those 30 years saved thousands, hundreds and hundreds and hundreds of thousands, millions of pounds over the 30 years in tax because we use dividends right from the early days. It's now become commonplace, and businesses that are not using dividends, either they're missing out on something or they've got some complication that stops them doing so. So that is going to take a massive turn for the worse now. It's still going to be better than salaries. I did some calculations the other day, and I can share them with you on a different video I've done for this dividend rule thing. But it's still better to do dividends than salaries until you get to significant amounts of income. When you start looking at over 200,000, 300,000 and 400,000 pounds of income, the skew changes a little bit, but it's reasonably small. You just need to bear in mind that you will be paying more tax now than then. Now, if you're on a 20% taxpayer on dividends, your tax is going to go up to 27%. That is a 30-odd% increase in tax in one hit. Now, can you imagine if the Chancellor put up tax for the normal employees by 30%? There would be riots, wouldn't they? But because they're doing it to us, owner-managed businesses, or self-employed people, we are the guys with gumption. We're the guys that take the country forward. We are the ones that employ people. We're the ones that create wealth in the UK, not the international firms which hide, which rip off people in the UK by paying them low wages and not paying any corporation tax and stuff. And we know all that. We're the bedrock of the UK, and we're being hammered by this third increase in tax. So all I can tell you, if you're not in the 150, 250,000 pounds income bracket, if you're in the 20, 30, 40, 50,000 pounds income bracket on dividends, then you are going to take a significant hit. It may be enough to pay, you may lose the money that you maybe spend on a holiday or holiday and Christmas presents. I did one with a client the other day. It was £7,500 he was going to lose out next year. That's what he tells me is what he pays for his family holiday and Christmas presents each year. Now he's going to have to make up that budget somewhere else, and he's joined a profit multiplier program because he can see that if he can increase his profits by 10, 20, 30, 40%, and over 2 years we're getting 100% increases in profits through the program, because it brings focus to the tiny bits areas that can make a biggest dramatic difference in sales, margins, and profits in your business and cash flow. Then that's the best way to bridge that gap. We're going to lose £7,500 to the exchequer. Can't help that, but we can make more money so that we make another £20,000, £30,000, and the Chancellor can have his extra £7,500 or whatever, and we'll still have more money than we had the previous year, even though we have a higher tax bill. So, please buckle up. You need to sort of ramp up now. The danger is, for most owner-managed businesses, they think the only way of doing this is to work hard, and there probably simply isn't enough time, energy, mental strength to work any harder than you're doing now. You're already working really hard in your businesses. And so the answer is not to work harder unless you've got 4 days off and you need to work harder, in which case you may need to get more clients or something, right? But that's where the Profit Multiplier program came in. And so you need to just build that focus. Watch our blogs. A huge number of tips come out in our blogs about what you can do in your business to manage the numbers, to manage the processes, which will identify where where to press. If you've ever been for a really good massage, a good masseur, with their elbows, I sometimes carry a lot of tension in my shoulders, and they will dig their elbows in the right spot on my shoulder and just releases the tension. Everywhere else makes no difference, but that pressure point with their elbow hurts for a bit, but then just releases that muscle pressure. It's a bit like that in the profit multiplier program. We identify the points that have the biggest impact. There's a whole lot of fluff in business. There's a whole lot of things you must do, and a lot of noise and interruptions and distractions. But I distract. We are talking about the budget, but we are going to get hit for tax. It's only going up, in my opinion. This is not coming down. It's going up. So you need to earn more money if you want to maintain your lifestyle. And I would suggest you need to do more than maintain your lifestyle. You want to build wealth. That's what you've got limited amount of time running your business before time runs out and you lose energy. The world changes and, you find yourself doing something, you're wanting to take some time off. So now's the time. If you've got the slightest inkling on growing your business, change what you're doing, how you're doing it, your thinking behind it, and focus on a couple of areas of your business that has the most dramatic impact. Sorry about that rant, but never mind. Let's go. Now we're talking about clients who sometimes, for various reasons, and the main reason my clients will have a loan to a participant, it's a loan to a director, a loan to a shareholder, is because they haven't earned enough money, but they need to take money out. And usually what they've done is they've taken corporation tax money, or they've borrowed money to pay themselves. And these are called loans to participators. And in the past, they were taxed at corporation tax rates, 20% stroke 25%, if you like the dividend idea. Now they're going to be taxed at 32.5%, big hike in that as well. So please bear in mind that if you are taking money out that you can't afford to because you've either borrowed it because you're not making enough money, or you haven't voted the dividend in time and stuff, then please look to make more money. Again, if you've missed my last passionate rant in a few minutes ago, go back and play that again and listen to what I've said on that. It's really important. Remember, you have 9 months after the end of the accounting period, and the accounting period is classed as a maximum of 12 months. So if you have a long period, it's 12 months plus 9 months. You need to make sure that within 9 months, you clear this loan. Either you borrow money personally, put it back in the company, or vote a dividend or salary or whatever, and pay the taxes on it, on the relevant thing. The thing about that is, if we get your accounts done within a month of the accounting period, so just say your accounts year end is December, and we get your accounts done in February, for example, which is quite common. Usually 8 weeks is good enough for the clients on our program to get accounts done, or even the ones on our Premier service or our management service, we do that. Then within 2 months, if you've got a problem. And then within those 2 months, you've got now another 7 months to make good on that loan, which is a lot of playing time. You can really do something in that time. Whereas if you do it off 2 weeks before the 9 months, then you get caught out. You'll end up with this massive tax bill. And we both know it's easier to pay tax than get it back. So when you pay this money and then you want to get it back a year later, and it is a year later, sometimes it's like getting blood out of a stone. It's so hard to get the revenue to pay your money back. And it just causes all sorts of problems, right? I'm going to talk about this next bits in the next video, so I'm going to break there. And in part 3, if you're skipping them, then by all means you might join at part 3. In part 3, we're going to be talking about capital rates and capital gains tax and entrepreneurs relief and that sort of good stuff. So before I go, let me just talk about VAT and micro employees. Let me just do that for you. So the first thing is we want to talk about is micro entrepreneurs. These are people who are starting on eBay, or maybe they have Airbnb. What you're going to notice is that the first £1,000 of earnings will be tax-free for these people starting up in trade. And even if they're micro businesses, which is to be defined fully in the legislation, and we'll talk more about that when that comes out, they can deduct the first £1,000 from their income, which is a nice touch. Not big in our market because we don't deal with startups too much. We have a startup a micro business department that deals with them, but just watch that space. The new corporate tax loss rules. We made a big corporation tax loss in the previous year. There's going to be a limit for how much you can offset in the current year. We had a client a couple of years back who started up a medical clinic, put a lot of money into the medical clinic, and that loss could not be utilized. All of it could not be utilized in the following year, whereas in the past you could. You could save a huge amount of tax against the profit-making period. And so, that's one of the downsides. Now, we will be able to offset that over time, but, keep that. It can affect cash flow quite dramatically. That can. So watch out for loss relief. I'm not going to be talking about interest relief on multinational companies because I don't act for any, and so I don't really care what they have to pay too much. They deserve to pay a bit more, I believe, especially people like Amazon and Google and Facebook who choose not to pay very much tax in the UK, even though people like me who advertise on them pay them a small fortune in the UK. They pay very little tax because they ship it to other EU countries which have very low tax. So on the basis that we can't do that, I don't care if they have to do that. So pay more tax, good for them. VAT registration, we've got this thing on VAT registration. So what I want to just talk about there is the limit has gone up to £83,000. If you're already trading, then it doesn't matter. But if you're starting to trade a new business and it's completely different and you're looking at VAT registration, remember we have a strategy for earning at least £10,000 more profit in the period between starting up and becoming registered completely legally, just because of timings and the psychology of pricing and the mentality of how you charge your clients and when you raise invoices, all completely legal. And it's important that you'd want to utilize that, because if you don't, you're going to lose out on a significant amount of extra cash flow in your business, whether you use that for your business as a startup and development, or you want to take it out and enjoy yourself and go on another holiday or two. The deregistration limit has also gone up by 1,000 to 81,000. So keep that in mind. And that's the end of this section. I'm going to be going on to the next section, which is going to be talking more about property, capital gains tax, entrepreneurs relief. So join me on that if you wish. And if you've had enough, thank you for joining me and thank you for listening to my rants. I'll speak to you soon.